The Hang Seng trading with losses of close to 1.5%.
The Asian markets are under pressure. You have the Dow that's lost out for the 6th straight session. And you have the dollar index, which is a very, very important Q. Well, that's at around 107 odd. So the Qs are perfectly stacked up for Friday the 13th. Query is that whether or not the bulls can surprise and, in fact, fight back at some time during the trading session.
We do expect our combined ratios to fall well below 98%.
About 30 to 40 points lower. That's what the Nifty is doing at this point in time.
Runway for growth from an insurance perspective is very long.
They have the widest distribution, and therefore utilizing the channel to spread insurance to cover people is absolutely the right thing to do.
IGI is the first gemological laboratory to go listed.
I think 2025 should be a good year, decent year.
The last 1 year or so, the metal index actually has outperformed what the Nifty has done.
Sharply lower on the benchmark indices, 1% gone, more than 1% gone on the Nifty and the sensex.
Its 2025 target for the index is now 26,600.
Regulator primary purpose on the banking front is safety of deposits.
And it indicates a further market share gain for Bajaj Auto's Chetak in two-wheeler electric vehicle space.
Recovery, that is the theme for the day for sure.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Absolutely stunning. The recovery that we've seen on Friday the 13th, the morning turned out to be dismal. The markets had breached 24,200. And now as we speak, it's a near 600-point recovery from the lows on the Nifty. And the Nifty is up 200 points. 0.9% higher now on the Nifty. The rally, the recovery is led more by the frontliners. So the mid-cap index is recovered, but it's still down close to about 0.3%. Fantastic, right?
Friday the 13th.
Yeah.
It seems to be good, right? Because, the last few, if you look at the average for the last 5 Friday the 13th as well, actually it's up rather than down. And today we were wondering in the morning whether Friday or 13th is actually going to be a bit of a bad omen for the bulls. That's not to be. And Rima, just two stocks. At around 10:30 a.m. when we were here for Chartbusters, when the markets went to the low point of the day, there were two stocks that also had moved lower, Reliance Industries as well as HDFC Bank. And the morning fall didn't come on very, very large volumes. Now, both these two names, identical. You pull up the Nifty, you pull up Reliance Industries and pull up HDFC Bank. All three graphs are almost identical. Nifty, HDFC Bank is, so at 10:30 they moved to the low point of the day, 10:30 to 11, and then in fact we saw a bit of a recovery. And the bulls, I think right now, Rima, the sign is clear that in the near term they want to defend 24,300 to around 24,500 odd mark. That's what the options data is telling us. That's where we are seeing buying, and even today we went down to around 24,200 odd, and from there we did see a good bit of a bounce. So it appears that's the level that they want to come and buy the Nifty.
FMCG has also done very well. So the Nifty FMCG index has recovered. Remember, it was under pressure at the early part of the week after GCPL, Godrej Consumers profit warning. But FMCG has rebounded 1.3% higher on FMCG. For the week, it's still down 1.5%, but a pretty smart recovery there. And IT has been, the sector of the day, sector of the week, sector of the month. The Nifty IT index has now moved 6.6% higher for this month and nearly 3% for the week so far. Interesting setup. The Nifty Bank, courtesy HDFC Bank too, is higher by close to about 0.5%. We'll talk more about stocks. Bharti Airtel is also another big mover. That's in fact the top Nifty gainer. And Jefferies has included Bharti Airtel amongst its top picks for 2025. And this is on the back of a 62% rally that we've seen in Bharti Airtel. Betting on Bharti, and that's pushed up the stock. Other notable gainers include an Ultratech Cement, Titan, Adani Ports, Adani Enterprises, Grasim, Power Grid, and then you've got FMCG and IT, as we said. Stocks, large caps in those sectors are doing well. So how should you position yourself in the last hour of trade? Mitesh is now with us for a few closing strategies. Mitesh.
Yeah. So I think a couple of things. On the index, today morning I was hoping we don't close below 24,400, 350 because that would have kind of given a reversal. But look at the recovery from our lows of 24,180. I wouldn't have said yes if you would have asked me in the afternoon that this was going to happen in the evening. surprising. But the good thing is that one, the closing did happen and we have recovered very well. Now the upward pivot of 24,800 should come into play. I think that's a very significant level, 24,800, 825 zone. If people have long positions, my idea would be to, take some profits off, wait for 24,825 to be taken out before you go long. But on stock specific basis, I think there are, stocks where we have buy signals. So Adani Ports, after a long time, after that big decline and then some recovery, I think is now showing traction on the upside. So buy here. Keep a stop at about 1240. Look for a target of around 1300 over here. And the other one which I like is LNT. LNT, it also declined with the markets in the morning, but has recovered well. So LNT is now a buy with a stop just below the levels of 38.45 and a target of 39.60 is what I would look for.
Okay, got it. Mitesh, just to clear that trade on the Nifty, you're saying at higher levels you would recommend booking some profits getting into the weekend?
See, I think given the fact that this level is an important pivot, the level of 24,800, I think it will make sense to, be slightly light. I would say not, don't exit longs totally, but yeah, I think reduce long exposure. I think that's the idea.
All right, got that. Thanks for that, Mitesh. We'll come back to you during the course of this trading session. For the time being, though, markets are just booming ahead. The Nifty Bank, big recovery. The Nifty as well, big recovery. I think the Nifty Bank recovery is, I think, close to around 800 to 900 points from the low. I think it's a full 1,000 points now from the low point of the day. But let's get in a couple of brokerage calls. Morgan Stanley in the recent report says that the Indian bull market is here to stay. Hormuz joins us to fill us in with highlights of that report. Hormuz?
We've been in a long phase of the bull market, right, with a lot of these participants in the street calling it an aging bull market. But Morgan Stanley is of the view that this aging bull market still has more legs to run ahead. Now, what the note says is that the bull market has now overtaken the 2003 to 2008 period in terms of length, although the returns of this bull market is just a third of what the market had seen in the 2003 to 2008 period. Now, the earnings cycle as well, the quarters recently have been disappointing, but they say that the earnings cycle is midway and the valuations too are not rich for our markets. Now, why can the Indian market last, the bull market last longer? According to Morgan Stanley, they're saying that the private investment cycle is picking up and that can extend the earnings cycle, which will further make valuations attractive going forward. The domestic inflows that have supported the markets all these months, it's not likely to fade away anytime soon as well. What they also say is that there are prospects of more free trade agreements, rupee trade, and that will further add a boost to the growth estimates as well. The per capita energy consumption, according to Morgan Stanley, is likely to increase in the next decade, and they see an upside to both earnings as well as valuations going forward. So in this regard, what you should own and shouldn't own, Morgan Stanley believes that you should own financials, consumer cyclicals and industrial cyclicals in the next leg of this bull market, and what you shouldn't own includes the likes of staples, utilities, healthcare and telecom. So these are some of the sectors that Morgan Stanley is a little cautious on, but is betting on financials, consumer cyclicals and industrial cyclicals.
Okay, and Hormuz, you also looked at Jefferies' India strategy note for 2025. What does it tell us?
It's a slightly cautious tone compared to Morgan Stanley, although Jefferies too sees an upside for the Nifty going ahead. Its 2025 target for the index is now 26,600, which is slightly above the 26,275 odd that we had made in recent times. What they say is that the 1 year forward Nifty price to earnings multiple is now trading above its 5-year average, and as a result of which it is expecting only 10% returns in 2025, which is in line with the earnings growth estimates. And considering the fact that it has a cautious outlook for the market, it is bullish on large caps over other broader market names within the mid caps and the small cap space. Now, what they say is that the investment cycle is currently in the 5th year, and they are expecting another 5 more years of this to continue. The housing cycles too continues to remain strong. The housing inventories are at a 14-year low, which is why real estate is one of their sectoral picks. We'll get to that in just a bit. The private capex is on the rise. There are opportunities emerging in power, electrification, PLI schemes, building materials and such sectors sectors as well. And it is this capex uptick that is likely to support this 6.5 to 7% GDP growth that we are likely to witness in 2025. So what is Jefferies overweight on? They're overweight on multiple sectors, right? They include bullish financials, IT, telecom, auto, healthcare, power utilities and real estate, as I just mentioned, and they are underweight on sectors like energy, staples, the consumer discretionaries excluding auto, materials, and they're neutral on the industrial segment. Now what they also say is that this domestic supply of funds that is likely to remain strong. The IPO market will remain heated as it has been this year as well, and this supply of paper will remain elevated until the market corrects and there is a change in sentiment. Now it has highlighted 9 names which are among its top picks, include the likes of ICICI Bank, Axis Bank, SBI, Coal India, Bharti Airtel, and most of these names have potential upsides ranging anywhere between 20 to 40%, but for the index it has a slightly cautious tone.
Thanks a lot for that, Hormoz. Well, let's get in Prakash Diwan, who incidentally loves to join on a Friday afternoon. Hi Prakash, good afternoon, good to see you in. Prakash, give us your take on a couple of stocks then. Hormoz mentioned quite a few of them, but how are you approaching the market? Anything you like as of now? Any particular stock that we could talk about? Page Industries, everyone was throwing in the towel at 35,000. Now it's on the way to 50,000. Your view on that?
Good afternoon, Nigel. So, Page Industries always, tends to kind of surprise by its moves, both sides, given the fact that the float is still not as large or liberal as you would want a stock like that. But, I think what's changing is the consumption pattern. And this morning you had Pankaj Tibrewal explaining it so beautifully in terms of the stratas at which FMCG or consumption needs to be looked at. Page would fall in what he said, the India A or whatever number one segment that he spoke about, the 10% premium users, and that's where consumption hasn't seen any kind of a let up. My sense is you'll probably see a lot of the money going into stocks like that as people start allocating more towards this sector. Page is a bit expensive. It's always been expensive when it does well. But, I'm sure within that category, you'll probably be able to find a lot of other names, especially in the second category, like names like Bata and all, which could kind of rev up as soon as consumption picks up, the aspirational India that he spoke about. So my belief is I would look at a slightly larger market share for players or segments that are much broader than just a narrow garment segment like Page. But also, since you're talking about Page, let me also tell you the textile sector as a whole has been reporting some amazing strengths. Now, whether it's a Bangladesh factor, or whether it's some sort of a restocking in Europe, which is taking off, but names like Gokuldas and all have been talking about, order book position, which are very healthy. So, that's where a lot of those things could come in. You have a name like PDS, which is much more global, doesn't just manufacture in India. In fact, it aggregates textiles and garments, apparel from everywhere in the world. PDS has also been talking about the same kind of thing in their commentary. So, that's a space that you could probably look at because it's got ignored. It still offers some comfort in terms of valuation as well.
Prakash, wanted to get your thoughts on the trends, the shifting trends in the two-wheeler electric vehicle space. Sudarshan has just put up. So for Bajaj, in April, their market share in two-wheelers was 12%. It's now come to 27.7%. While for Ola, it's fallen from 52% in April, now down to 18%. And consumers, retail shareholders will soon have a choice because Ather Energy is also looking to IPO very soon. So talk to us about this increasing aggression shown by the incumbent players, TVS as well as Bajaj, and what this means for Ola Electric.
So good afternoon, Rima. So, what these numbers tell you is that the electric two-wheeler market is racing ahead in terms of adaptation to be far more stronger than the PV market. And for obvious reasons, the price points at which you are getting vehicles now, the affordability, and Mr. Gadkari mentioned in the last IBLA evening chat that it's 1/10 the cost of running a two-wheeler on electric vehicles on electric batteries. So you can imagine that is a market that's very sensitive to cost of usage, and that's where the adaptation is happening. Very quickly, I can also tell you that the robustness with which the electric vehicle engineering has transformed, especially the Chetak model, it's far more sturdier, heavier, dependable than some of the other vehicles that I have seen. And I'm sure with Ather and with Greaves Cotton upping the ante, there's going to be much more to kind of select from. So it's good for consumers, but the market share will keep on kaleidoscopically keep on changing very rapidly, because everybody's going to keep experimenting with newer segments, price points, performance features. So you'll have a market that's very fast in terms of evolving. So I don't think you can really peg at this kind of thing that this is how it's going to stay for the next 12 months. But yes, it's going to be interesting. Ola, of course, you need to give credit to the fact that they introduced people to this whole concept of EV two-wheelers. And then, of course, distribution strength and superior engineering skills from Bajaj have started showing some sort of impact. And that could continue for a while. So it's once the larger OEMs throw their hat in the ring, it's going to be a very different game. And that we've already started seeing. So good times. The adaptation is what will surprise all of us in a couple of years from now.
It'd be interesting, Prakash, as you said, Ola introduced this theme. It's hopefully not going to be like, I don't know, it's English taught everyone cricket and they didn't win a World Cup for many, many years, till many World Cups later.
Happens.
Indeed. Prakash, one more quick word on Paytm. People had counted it out at $400. Stock's on the way to be a 1,000 rupee stock. I guess there is some kind of a large trade as well in the works, which could probably be one of the reasons. But what's your view? Most of the juice done at around 1,000 rupees. It's the same stock that came out with an IPO closer to 2,000.
No, so from those metrics, I'm sure there's much more that could follow. It all depends on what stance Paytm takes, as in the company goes into which direction, with maybe a potential acquirer trying to put their weight behind it. Because it has a footprint which is second to none. The way they've kind of introduced digital payments in the country, the kind of adaptation that has happened post that, you have a lot of people who have come in after that, but they are just marginal players even now. So Paytm has that strength. If somebody needs to kind of leverage on that in some smart way, and which is also commercially viable within regulatory frameworks, kosher enough. So you have a lot of those ifs and buts, but if all that falls in place, I don't see any reason why it cannot start looking justified at even that IPO price in some years from now. But at this point in time, it will probably be an uphill move. It's a slow grind. The changes will not be very rapid because of the scale. But yeah, you could probably expect it to outperform broader markets at some point in time in the next 12 months. But the big move that you've seen from the dumps to some sort of a hope emerging so strongly, I think that's largely done. You'll probably have to be more patient with it now. But people who own it from lower levels, it's a good trade-off to continue holding it for some sort of upside that will come through the news.
Okay, if you have it, maybe you could still hold on to it and ride, for further upsides. Prakash, I wanted your views on metals, but I'll just tell our viewers first about the index on the whole. On today's trading session, the index is lower. That's after 6 trade sessions that it ended higher. In fact, in the last 1 year, the metal index itself has outperformed what the Nifty has done. That comes up for you on the screen. A few factors have played out here, and that's why that index is lower, though it's recovered considerably from the low point of the day. One is the dollar index was stronger, went to around 107 after the inflation print that we saw yesterday. A stronger dollar is not good for base metal prices. So because of that, we could see some pressure on some of these metal stocks. The second factor is China. They're talking about stimulating the economy. They're saying the fiscal deficit number could go up. This year it'll be around 3%. Maybe next year it could go to around 4%. They're also talking about, a higher amount of borrowings, which in turn could help stimulate the economy. But the street wants more concrete measures. What are they doing with regard to the property market? What are they doing with regard to the real estate market? Now, that's what's going to help consumption, which has clearly been lacking. So a bit of a, shortfall on that front. Next up, the steel minister yesterday was putting an aggressive pitch with regard to the duties that he wants in place to protect the domestic industry. We had Mr. Sajjan Jindal as well at an event organized by CNBC-TV18 that he as well made a very, very strong pitch. He said that, India is still like a child, in terms of the steel industry, while you're making us compete with an adult, which is getting so much more incentives. So let us grow into an adult, then we'll take them head on. But for the time being, you're looking at protecting ourselves from these imports. And, that's the strong pitch. But nothing has yet come about. So that's why the street is losing a little bit of patience. In fact, yesterday towards the end of trade, you saw a lot of buying on the metal stocks. And, finally, since you're having a lot of this negative news that's coming in there, we had Pankaj Tripathi, who joined us earlier today. And he said that's the contra pick for him in 2025. Few reasons he gave. One is that it's underowned. Second factor is two largest economies, US as well as China. They're looking at stimulating their economy. And also made this point on profitability. The contribution to the total profitability from metals is the lowest since 2001. So the index is still down, but recovered from the day's low. Prakash, what do you like? That Nalco trade I want to know as well. The prices, went all the way to around $800. I remember that was one of your picks and it did quite well. Then it gradually cooled off. And if last I checked, it was closer to around $690 to $700 per ton. But most of the street are working with alumina prices at $550 at most. So it's still higher than what the street is expecting. What's your view at 230, 225 rupees?
So, I think it's probably another opportunity for people to add on for the simple reason that the alumina prices move was a bit too sharp because of shortages, and all know that was abnormal. But my sense is the alumina prices, if you look at bauxite prices, they have been strong forever. I mean, there's been absolutely no slip up there. And if that is any indication, alumina can't not follow that. So very clearly, it's going to be firm. Maybe it's better or healthier if it kind of gradually moves up as the demand comes up. Now, this China factor that you spoke about while explaining it so brilliantly in terms of what the entire sector is dealing with, is also impacting the likes of Nalco and Indalco and Vedanta. So, the non-ferrous side is something which we typically don't look at on a very regular basis in terms of stimulus from the Chinese economy, but it's going to make a big difference. And lastly, I can tell you, the US, until the US announces what it intends to do, what Donald Trump intends to let the world know as its policy direction, nothing's going to happen much in terms of people buying it. But so you'll probably get a window to buy or accumulate these names because these are two large consumer economies which will need a lot of metal being produced. And as of now, I don't think there's anything happening on that side. So that whole thing of, and I do agree with Pankaj's view that the bottoming out is probably because it's underowned. So it will happen. The balance sheets are much more healthier. Even if the safeguard duty doesn't come up, I think companies in India can reach scale and profitability at some point in time, if not immediately. So definitely it's a good long-term play. But Nalco is still very, very positive and would urge people to look at it from a slightly longer-term perspective, which we've always thought. And it could still deliver in terms of the change that's happening on the scale and profitability.
Prakash, we leave the conversation here for a change. We didn't ask you about the Friday favorite stocks, but I do hope you enjoy it. If not the stocks, but you do enjoy the Friday favorite goods. Thank you very much for joining in. As we slip into a break, here is some good news for all our viewers. India's business news leader is now just a click away. So we're introducing CNBC TV 18's all-new app. Get instant access to breaking news, in-depth articles, financial world updates, all on your fingertips. So download the CNBC TV 18 app now from the Apple Store or the Google Play Store.
Welcome back. Well, the markets are still holding with around 200-point gains, but a few stocks actually have slipped in the last few minutes. So you have Bajaj Finserv that's moved a little bit lower. Tech Mahindra as well has come off, the peak that we saw. So just keep an eye out on that one. But Axis Bank has seen a good recovery from the low point of the day, and there appeared, going by the delivery-based data, that there was a rather large seller, in the last few weeks. And that seems to have got cleared out. So let's see whether or not, because that large seller has moved out, that's why we're seeing a bit of a recovery as well. And the stock is getting bought onto some dips. Well, let's go across to Sudarshan. He is here to tell us about the interesting Vahan data that we got earlier on the electric two-wheelers. Sudarshan, the winds have changed. Things are changing around over here.
That's correct. So Vahan data for the first 12 days of December indicates a continued gain in market share for Bajaj Auto in electric vehicle space. Bajaj Auto's Chetak is now #1 player as per Vahan data. If you compare from the month of November, Bajaj Auto's market share in November was around 22%. Now, in the first 12 days of December, market share has surged to nearly 28%. Exactly, it's at 27.7%. But the question is where exactly it has gained from. So at the same time, Ola has lost its market share. Now Ola's market share has dropped to 18% from 25% that it had held in the month of November. And for TVS also, it has lost market share by 100 basis points against November, but still it's number 2 player. Now, on the sales front, in the first 12 days, Bajaj Auto has sold almost 7,000 units of Chetak against Ola Electric sale of nearly 5,000 units and against TVS Electric sales of almost 5,500 units. But if you look at the market share in fiscal, that is FY25, in the month of April, market share for both Bajaj Auto and TVS was 12% each. Now from 12%, Bajaj Auto's market share has risen to 28%, and for TVS, market share has risen to 22%. For Ola Electric, market share in the month of April 2024 was at 52%. From there, market share for Ola has now fallen to 18%. And this fall has come at the time when Ola has been launching. In the month of August, it has launched motorcycle with the name of Roadster. Last month, it has announced a new range of scooters, and the range was around 39,000 to almost 65,000, which was lowest in this segment. So it's a bit of concerning for Ola Electric, but it's happy going for Bajaj Auto's Chetak.
Thank you very much for that. Jigar Misri, co-founder at Buoyant Capital, is now with us on the show. Jigar, before we get talking about specific sector stocks, what's the overall view on the markets now, and what would you attribute this intraday recovery to?
Hi, Rima. Pleasure as always to be on your show. I think, yes, things are getting choppy and increasingly so. I think we are going to have a situation where there is this constant ongoing fight between how the rolling earnings per share is going versus the share price performances, right? So if you look at, say, a 5 or a 10-year rolling for large cap indices, small cap indices, or specific stocks, you see that there has been a complete lockstep correlation. However, the current observations across the board, right, in case of, say, large caps, it's something like 18% earnings growth versus 30% stock price performance. Small caps, it's wilder, 17% earnings growth versus 50% stock performance. And I think a large part of this can be attributed to the fact of how much wealth retail has made over the past 4 or 5 years, and them choosing to continue to invest in the same sectors and the same small cap mutual fund, which is resulting in this sort of dislocation between earnings and share price. And I think eventually there will be a tug of war as to whether flows win or fundamentals win, and we'll have to sort of see how that pans out.
Hi, Jigar. Good afternoon. Good to see you in. Jigar, I think you're quite positive on the insurance space, but now the regulator is turning the heat on. It appears they're not too happy between the relationship of, the insurance company and the parent, which is the bank. They want to restrict that. Do you think there's a big risk? The street is clearly nervous. Yash has been on top of this. And, every time the stock sees some kind of recovery, this news comes about and they do see some selling. So since the regulator is looking at it, do you think it's a big risk? And if there is weakness, will you look to continue to add on to your positions?
Yes, Nigel. So I think insurance space, our conviction has so far been driven by the fact that, as a market, India is pretty sort of uninsured in most respects, but even more so in the lives part of it. And in that framework, you have always found a reason as to why you should be, long these names. The open architecture system which you are alluding to is something that I think they're trying to enforce for a while now. They initially said 3 players per bank at least, and then that resulted in some widening of exposure. And essentially, eventually they are now getting a little more, specific on those. My sense is that, who eventually distributes the product does not hold as much relevance in the longer term to the fact that the insurable market is still around. And that will eventually result in volume pie going up. It might get distributed differently from the historical parameters, but therein obviously lies that incremental opportunity as well. So that's the one name that we have, sort of been holding on since I think 2019. That sort of max is something that we continue over periods of time. It will continue to surprise us positive.
So, many of these life insurance companies like an HDFC Life, SBI Life, they've all lost about 20-25% in the last 2-3 months from their recent highs. Have you been adding to your positions in this fall?
Yes.
You have been. Okay. Where else have you increased your exposure? What are you incrementally more bullish on now?
So I think, one sort of trend that we are observing and getting positioned to some extent is the fact that if you look at post 2015, then you are seeing this, continuous effort by the government to, channel and crowd in a lot of private capital spending. Prior to that, if you remember, corporates were very happy to keep spending, creating new capacities in the hope that, the future will behold a lot of upsides. But since 2015, the NPA crisis, then the IBC coming up, promoters going to jail, the first leg was driven by how well the government capex spending was happening. And the government's hope was that eventually private spending will join them. And that will result in a cohesive growth of capacity addition in India. Increasingly, especially over the past few months, you're seeing that state governments in particular are choosing to have a very different distribution of their, budget, if you like. So with all this, you can broadly club them as freebies, whichever name you want to call them with. You giving them sort of, free electricity or some sort of a sustenance or the continued, free food and ration. That might actually skew a lot of government budget into how, India spends. And unless the private sector comes in and joins vicariously, you're not going to see a situation where the elevated valuations of a lot of these businesses will sustain. So whatever sort of wealth cash transfer is happening between the governments into the hands of people could actually result either in a lot of those monies entering the financial channel, and therefore banks who've been struggling with deposit growth might have some respite. Obviously, we saw the CRR cut, and that lends liquidity as well. Or it might actually end up being consumed, and the feeble staples growth that you are seeing might see a turnaround. So I think increasingly from the sort of very high valuation capex driven sectors, you might find out that not so expensive anymore staples and not so expensive anymore financials might continue to do fairly well over the next 6 months or to 12 months or so.
Let's talk about our first sector that we discussed, Jigar, 10 years or more than that ago. Metals, 2 of them actually, metals and cement. Now, both of them have had a rough going in this year, 2024 so far. But some part of the street believes 2025 will be far better. For cement, there is some evidence actually on ground as well. What are you buying out there, and what are your current positioning? Because I'm looking at cyclicals, it's not very, very high as of now. And at one point of time, you're the master of cyclicals, Jigar. I remember November and February, a lot of calls between you, me, and try to pull you out of your meetings with your clients.
Yes, Nigel. So I think part of that has also got to do with how we run the fund, because if you look at from say March or April 23 to September, there are more than 900 stocks which have more than doubled. There are 83 stocks which have gone up more than 500% in under 18 months. If I remind you, 2007-8, when we saw that rally end, there were only 156 stocks that had doubled. Now, given far fewer listing versus now, but still the kind of rally that we are seeing, leaves a lot to be desired. Especially to your question on the cyclicals part of that framework, I think steel is something which is getting very, very difficult because China is incrementally finding out ways to supply material even when you start creating barricades. If you remember, Europe did it first, then US came, then India tried doing something else. And eventually the hope was that you will be able to protect sort of your own margins. But the eventual onslaught of Chinese steel continues. So I think that's not something that we have been keen for a while now. But non-ferrous space is something that we are very interested in, and what's showing on your screen, Vedanta, is something that we continue to own. And I think the bigger play here is that eventually US cannot and will not be able to get away with printing $8 trillion. And therefore, everybody is reducing their exposure to the US currency. To that end, every country will de-dollarize in their own way. I think for a large part outside US, it will be in the form of harder currency, harder commodities. And therefore, non-ferrous, which is an exchange-traded metal, is something that makes a lot more sense to us. If Vedant at the corporate side is able to execute all that it's promising, then it will be an added bonus. But otherwise, I think even at the commodity price level, things are looking fairly decent. On the cement side, I think, this whole consolidation game that we have been talking for 22 years now might come to sort of roost, because eventually now have 3 or 4 players which will drive the consolidation gains. But within that lies some bit of a question as to whether, even in the top 3, would one of them want to become the top one at the expense of other? Because at the entire cost curve so far, we have seen every company try and make at least cash profits enough to pay out their interest payments. But if the order of the country's top 3 is changing, then that might result in some bit of, commotion even still left. We have had some exposure. We continue to have exposure in cement. I think in the entire scheme of things, that's among the cleaner way of playing the infrastructure growth in India. But pricing is something that we won't have clarity on for a while, I think, going into the future as well.
Jigar, thank you very much for joining in. Enjoy your Friday and your weekend. We'll get into a break. We'll come back and get a check on what dealing rooms are saying. Nimish is waiting by.
Welcome back. Well, the markets continue to do well. We're up close to around 220 points. So after all, Friday the 13th wasn't so unlucky for the bulls. Nimesh joins us to tell us what's he picking up in terms of flows. Well, Nimesh, the bulls actually will be happy. They got that dip this morning and they just charged into it. How are you reading the flows?
Oh, absolutely, Nigel. 550 points, almost a swing in the Nifty from the intraday low. So that's the kind of volatility we've seen in today's market. But again, even the fall in the first half was not backed by large institutional buying, institutional selling, or larger volume. So it looks like it's a mixed day as far as flows are concerned. Pretty much 1:1 on the buy-sell ratio. In terms of sectors, where there's buying, select autos and select private banks is where a lot of, looks like there is a larger institutional flow in today's market. So these are two sectors to watch out for from a flow perspective. I guess even if you look at today's recovery, it's sharply recovered from that very crucial support of 24,300 on the Nifty. So that again stands out as a very important support level on the downside. But given the fact that we've recovered so sharply in today's market, looks like this momentum can continue, especially in the broader markets in the days to come.
All right, Nimesh, I want to ask you about Manappuram, if you've heard anything. The stock got absolutely smacked out, went to around 150, it went into that F&O ban, and from there it's seen a good bounce. And as we speak, I'm looking at the data, it could probably go into the F&O ban yet again by the end of today.
Correct.
If you've heard anything on Manappuram and also the other stocks you're tracking, Nimesh?
So first on Manappuram, Nigel, as you rightly pointed out, it came out of the F&O ban just yesterday and looks like it'll go into the ban again today. In terms of triggers to watch out for Manappuram, there are a couple of triggers to watch out for. One, there are extensive media reports which are indicating that maybe a private equity investor may look to buy a big stake in Manappuram. So that is something as far as deal is concerned. Also, watch out for any regulatory action in Ashirvad. Again, there is an anticipation that maybe you'll hear some relaxation as far as the Ashirvad, the MFI of Manappuram Finance. So these are the two specific triggers why the stock has reacted positively and has been seeing some bit of buying interest as well in the last couple of days. So that's to do with Manappuram. Now coming to individual names, there are a couple of stocks where there was aggressive delivery-based buying and have seen a recovery, which is Tata Motors and ICICI Bank. Both stocks have recovered sharply from the intraday lows today, largely on back of very strong FI buying. So expect high delivery volumes and looks like the FI interest is back in both those large cap names. The second is a bunch of mid-cap movers which are buzzing off late. Centrum Electronics, Hindustan Construction, HCC and Skippers all have been buzzing in the last couple of days and in good volumes as well. And for all the three, the common buzz seems to be that maybe all the three are lined up for some sort of fundraising in the days to come. The third is Indus Tower. While the stock has recovered from the intraday lows today, but for the third day running, I understand there is aggressive selling from larger FIs in Indus Tower. So expect delivery-based selling in Indus Tower for the third day. And the last is a couple of large names where the expected blocks are likely. Kotak Mahindra Bank and HCL Tech. Kotak Mahindra Bank, I highlighted a week back as well that maybe the large pension fund could be a potential seller. So looks like that block is round the corner and come very soon. And even in HCL Tech, there is an indication that maybe there could be a large block in HCL Tech as well. So these are the two names where large blocks are expected.
Thank you very much for that. By the way, the Nifty PSU banking index is also about to break into the green now. So that's showing a steady recovery. Though individual mid-cap banks are still under pressure. UCO Bank 4% gone, IOB down nearly about 3.5%. Central Bank also down close to about 3%. Mitesh is now with us for a few BTST calls that perhaps you could take for the weekend too. Mitesh?
Yeah. See, I think HDFC Bank looks the safest bet in this market, I would suggest a BTST there with a stop at about 1860 for targets of 1890.95 for Monday. And the other one is ICICI GI, which is closing at today's high. So BTST here with a stop at 1969 for targets of 1995.
Okay, all right. Thanks a lot for that, Mitesh. Well, I'll tell you what, we'll slip into a short break before we wind down on the market. So let's slip into that break. As we do that, let's get you some market opinion. Pankaj Shibribal of Ikigai Asset Manager tells CNBC-TV18 that this market correction is actually healthy and quality is making a comeback. He also gave his take on metals, cement, as well as the BFI sector. Let's listen and slip into that break, come back, we'll wind down the markets.
Couple of sectors which are looking probably interesting and maybe contra at this point of time. One, I believe, is cement. I think the worst in cement is behind us. The second, I think, is metals. It's a complete contra thought, but we believe that the contribution of metal sector to the overall profitability pool in the country is back to 2001-2 levels. And that's an interesting space to be in because two of the largest economies in the world will have a fiscal loose policy. From a 2025 perspective, a couple of sectors which are looking probably interesting and maybe contra at this point of time. One, I believe, is cement. I think the worst in cement is behind us. The second, I think, is metals. It's a complete contra thought, but we believe that the contribution of metal sector to the overall profitability pool in the country is back to 2001-2 levels. And that's an interesting space to be in because two of the largest economies in the world will have a fiscal loose policy.
Welcome back. Counting down to the close of the day, the week. And it's a good Friday. The Nifty is ending with a gain of more than 200 points, closer to 24,800, having made a stunning recovery from the lows that we hit, closer to 10,1030. For the week, we're up 0.4% on the Nifty and about 0.5% on the mid-cap index. IT was the star sector. Hemang Jani is now with us on the show. Hemang, big move seen in Bharti Airtel. Have you picked up anything which could drive this kind of 4.5% up move?
Yeah, good afternoon, Rima, and thanks for having me. So basically, we had this price hike news which has been announced by Jio to the tune of 2.7%. And at the end of Q2, if you look at the ARPU, Jio has an ARPU of 195.10 and Airtel has an ARPU of 233 and Vodafone is at about 166. And when you look at the, ARPU increase to the EBITDA, correlation, in case of Bharti, it is the highest. So clearly, there is an expectation that there is going to be a price hike that Airtel will announce and the overall impact on the EBITDA will be the highest. So which is what probably is driving the stock. But I think at this point, the risk reward looks more favorable for Reliance Industries versus Airtel at this point.
Okay, got that. What else are you liking now in the markets, Hemang?
So textile as a theme has been doing well, and when you look at the companies, I think both from this entire turmoil issue which is there in Bangladesh, plus on the export side, you're seeing that most of the companies are showing good market share gains, and the cotton prices are stable. So I think the whole host of companies, be it something like a Vardhman Textile, KPR Mill, Gokaldas Exports, Indocow, Himbal Sinka. I think the entire basket is looking quite interesting to us. But if I have to pick maybe one or two companies where we like the fundamentals and the valuations both, I think Vardhman Textile and KPR Mills. These are the two companies where we have a very positive view at this point.
Okay, so you like textiles, in particular Vardhman Textile, and the other one is Bharti Airtel. What about Godrej Consumer? That's the one which took a big slam dunk this week, ending with a 10% loss for the week. The management came on the channel and indicated that the issues are transitory. Volumes should start recovering, say, by Q4. So would you bet on it, given the fall that we've seen?
That FMCG store consumer sector is going through a bit of a slowdown, and while many people have this hope and expectation that things are going to revive, but we have to see the previews for Q3 whether there is actual recovery, and more so when most of the companies are taking a price hike. We are not very sure how much volume impact it may have. So as a sector, since it has corrected a lot, maybe something like a Britannia we like, because the volume growth there was about 6-7%. But by and large, there is nothing exciting in terms of triggers that one can really look at.
Okay, all right. Hi, Hemang. Good afternoon. Good to see you. When I want to talk about these capital market themes, everyone thought maybe volumes have fallen. We'll see a lot of downtick out here. But actually, stocks like Angel One, they're seeing buy on dips that's worked out. BSE has come back in style because of these new restrictions. They are better placed in comparison to NSE. Both will lose volumes, but it still means that BSE can still take up a larger part of the derivative market share. Your view, big move is what you've seen.
Yes, Nigel, absolutely right that the theme has done pretty well, but we need to do a bit of a reality check here. When you look at the actual market volume and when you compare November versus October, the dip in the volume at an aggregate level is about 24%. Now, many people in the market are saying that when it comes to premium turnover, the actual dip is much lower than 25%. Also, in case of BSE, the margin improvement case is there because what they have to pay to the government is linked to the notional value, whereas the revenue is linked to premium turnover. So there is going to be an expansion when it comes to the operating profit margins for BSE. But my feel is that we need to let the volume settle down because regulatory is coming down heavily. Today they have come out with some sort of a guidelines for the algo trading. the settlement rules, there are sweeping changes. So we need to see at the ground level what kind of volumes are we really going to see in the near term before taking a call, because we think that these are all stretched valuations. The consensus is very aggressive when it comes to certain numbers. So not very comfortable buying into PSC or for that matter some of the discount brokerage names like Angel, which has very heavy dependence on the F&O revenue.
Swiggy, 6% up now on Swiggy, and this month itself it's up 13.5%. So after it crossed 500, it's literally taken off. 534 now on Swiggy. Comfortable buying Swiggy even if you have a long-term 3-4 year time horizon?
Platform as thing is something that everybody is trying to get to, be it Zomato or Swiggy, even the newly listed companies, Blackbuck, it has actually shot up almost about 40-50%. So I think people are heavily banking upon the growth on a quarter-on-quarter basis, and I do think that at least for the next 2-3 quarters, there is going to be enough momentum and surprise when it comes to growth. So yes, the stocks have run up, but it would be good to have some allocation towards either Swiggy or Zomato.
Okay, got it. Hemang, will you look to buy into this dip that you've seen in metals? I think you had a view on some of those metal stocks. Any view?
So Nigel, time and again, people have high hopes and expectations that you will have something coming from China in the form of stimulus. But actually, it has not really played out that well. And also, the market was a bit disappointed that the government took far longer to have some sort of protection for the incumbent players. So not too keen to get into it because you have enough party on the mid-cap side of the market. So why chase something which keeps on coming up with this kind of volatile moves? So would avoid metal at this point.
Okay, all right. Hemang, we thank you for joining in today, filling us in with all of those stock advice. Wishing you a good evening and a rocking weekend as well ahead, Hemang. Well, let's take stock of the markets today then. It was a good trading session. Friday the 13th didn't work out, mind you, because it was very, very good for the bulls. The bulls got that dip. They bought into it. Stocks that did well today, you had HDFC Bank and Reliance Industries from the day's low. Both of them did very, very well in trade. From the frontline stocks, you had Bharti Airtel that did well. That stock was up and about. You had ITC as well that was cruising away. And Kotak Mahindra Bank, that's the other stock that did well. So those are all the top nifty gainers in today's trading session. What saw some profit taking? Shriram Finance and Chola Investment. Both of them were under pressure in trade today. A couple of other pockets on two opposite ends. One was on cement. You had Ultratech Cement, Ramco Cement and Star Cement. All of them did well in trade today. What didn't do well? Some of those metal-related names had come in for some profit taking. So Tata Steel was down. You had Nalco as well. That was a little bit lower in today's trading session, though the index itself did come off the day's low. So Rima, a good trading session for the bulls, though I still think the 25,000 mark will be a bit of a resistance for the bulls. But buy on dips seems to clearly be playing out.
Indeed, it was close to about, a 500-600 point recovery from the day's low. Mid-caps and small caps, though, end marginally in the red. Mid-cap pretty flat, but the small cap index was down 0.4%, and it's closing the week with a cut of close to about 0.5% on the small cap index. Some of the notable winners on the mid and the small cap universe, Swiggy is one of them, so that stands out. You had Indus Stars, Star Cement, which you spoke about, Manappuram Finance, 2.5% higher, IOC on the back of the Jefferies upgrade. A couple of textile names were higher in trade. On the way down, SAIL 3.5% lower, PSU Banks, UCO Bank, IOB, NMTC 2% gone. Sagility has been very active, but that gave up, saw some amount of profit booking. And then you had Nalco. Nalco's lost 9% for the week so far. But we've wrapped up the day, the week, and it's been a good Friday for the bulls, though the advanced decline ratio did end in favor of the losing side. Next week is crucial. We've got the Fed policy. We're going to take your leave and closing bell. It's a wrap here, but don't go anywhere. Editors Roundtable is up next.